Let's go. Here we are. Let me set up Anto over here. Yo, Anto. Set up thine stream. Let's add some birdie to this stream. There we go.
Yep.
Get this bad boy going. All right, let's see. How do I add your birdie? I believe I do so by doing this and doing this. Doing this. Yes, this one, please. Doing this. Do that. Do that. Okay. Birdie incoming. Should be anyway. Discord. I think it's called this. Live voice chat 1, yeah. There we are. Birdie! Alright. Now we crop. That's not what I wanted to crop. Beautiful. Yeah. That's a good bird. Alright, hang on. We're working on this. We're almost there. Let's see. Why can't I... There we go. Make this smaller. Make this smaller. Make this smaller. There we go. Perfect. Now we put you here next to me like this. And I think all I need to do is just... No, that's not good. Birdie is more important. There we go. Birdie! I'll just sit over here. All right, so let's start of the stream here. We have bird stream with my face next to it. Absolute beauty. There we go. Birdie. Birdie's what matters. There, birdie stream. Maximum birdie stream. Oh, look at him. Yo, let's go. Let's go, birdie. Look at him showing off. Coco's so pretty. Her name's Coco, and she's a good girl. It's Anto's burp. Yeah, it's a really pretty tail. So Coco's here to tell us all about the stock market today. I'm just here to provide extra commentary. And yeah, Coco loves you all. That's the message here. It's looking a bit frazzled, but that's just how Coco do.
About scary bonds, Coco.
Yeah, tell us about the real yields, Coco. Coco, if you bite his finger, then you think real yields is going back up. Is that what you think, Coco? Is that what you think? Yeah, there we go. Real yields are going back up, aren't they? Yes. Yes, we're not out of the woods yet, are we? No. So Coco's with us for about 20 minutes, and it will be the highlight of the stream today. I also got a green screen, but that's not nearly as important as Coco's performance here. So yeah, let me actually switch to the studio mode here so I can set up us both next to each other a little better. Let's see, how do I do this again? Like this, like that. I want to set up hue like so. Is this the one I need? I think this is the one. That's a bit weird. Not doing live chat on Discord, just LVC1. I'm not sure what that means, but sure. What does that mean? Yeah, let's set this up like this. Transition. No. Okay. Now I need to turn this on. There we go. We're featuring Coco again. Maximum Coco. Pure Coco potential. Here we go. All right, there we go. Now we're both in screen. Oh, there goes the pen. Thank you. I like the new green screen too. It's if I move too fast, it's not great, but other than that, it's I'm pretty happy with it. So yeah, welcome everyone. 9 viewers for Coco. Honestly, I'm the accessory here. Coco is the main dish. Thank you. Yeah, I do think it looks a lot cleaner. I really didn't like the background of my office, and like there's a heater there, and just the couch, and just it's not that much space, so it's I'm much more content to just show you me, and let you bond with my beautiful face. That said, as you can see, me is much smaller than Coco because Coco is just better than me, and I'm willing to admit this. Thank you. I'm really proud of it. I'm really glad it's all set up. It's not perfect, but it will most certainly do. So yeah, welcome guys. So what's been going on today with stonks? Let me see if I can open up my own stonks, just so I can take a look. I'm actually green today, which I didn't expect. I started pretty green this morning. I had like 0.2% up. Then TSM took a dive, and Coco warned me. Coco knew all about this, but I wouldn't listen. TSM went from like 5% up to 1% up, and then even in the red, I believe. Now it's back up to 4% up, so we're back where we started. We're seeing green in tech. We're seeing green in, I've got green in fintech, biochips, or not biochips. We're seeing in chip tech, just semiconductors, green. Gaming is green. Even miners are turning green. So Cocoa isn't in the stream Lamau. Wait, that's not good. Hang on. Have I been denying Coco? Oh yeah, Coco's right there. What are you talking about? Coco's right there. You don't see Coco? Of course you see Coco. I see Coco. Coco's right there. Right there. There.
Sure.
There's Coco.
Sure.
There. Right there. Who's your good girl? Yes, poke him in the face with that pen. That's what you get for being wrong. So yeah, Anto unfortunately has to go soon, so we won't have Coco for the entire stream, but we do have some Coco. Pure Coco energy. Unless Coco poops on his shoulder, then he might have to go earlier than expected. So, there she is. Yeah, Coco. She's gonna poop on me for sure. Rip. So yeah, what we were looking at this week is real yields went up for the first time in a long time, and the same as last week. And so we're seeing this pressure, and everyone's kind of looking at the Fed like, okay, what are you going to do? And then the Fed, dropped a huge nothing burger on the market. It's like, oh, they're not going to do anything. Except not doing anything in this case means doing a lot, because they're still printing money, they're still buying bonds, they're still buying up debt, so they're still monetizing their debt, and they're still transferring debt onto the balance sheet. So woohoo, QE infinity. That deflationary pressure, or to counter the deflationary pressure rather of an indebted economy, you're kind of in this cycle, right? Because when an economy goes from when the debt to GDP goes closer to the GDP, and in this case it went beyond the GDP, but the closer debt to GDP gets from 0 to 100%, the more deflationary pressure economy usually sees. They want to counter that with inflationary pressure, which you create by printing money. The problem is that the printing of money creates more debt in this case, so that extra debt creates more deflationary pressure, and you get into this negative spiral that can only go one way, or only can have one result. So they're now stuck in this spiral. If they stop printing money, the economy collapses. If they continue printing money, the economy collapses. The question is, what's wisdom now? And that's hard to kind of determine. I personally think that austerity is the way out, or technology, but I don't think this rampant money printing is a solution, and that's why I'm hedged with precious metals, and the market's taking a dive again. So, like, the part of the reason why I like giving this stream at this time is markets are still open, so we can kind of take a look at the market together, and kind of report on what's going on. I know Anto isn't having a great day today. Commodity is starting to look up a little bit, at least, and look at Coco. Coco's eating a pen. Coco, Bite the rubber if you think that Powell doesn't know what he's doing. Yeah. See, Coco made a prediction. Oh, she wrecked the pen. It's done. Full on rubber
Ripped it
destruction.
off. Didn't like Powell.
Yeah, doesn't like Powell at all. Like, I haven't seen her rip off like whole pieces of rubber before, but now that I mentioned Powell, she's like, yeah, I'll rip him a new one. So Coco made that prediction right there. And Coco's never wrong. So Powell doesn't know what he's doing, and we're seeing this QE Infinity launch. The next stop is she is doing her best, yes. The next stop is yield curve controls, which means a potentially infinite amount of debt to try and control the yield. And you can technically do that. You can print so much money that you're controlling the yield curve, but the question if that's wisdom or not. I don't personally think so. And I've talked about it last stream, but what happens is you've got this deflationary pressure from being in a debted economy. Then you've got money printing, which should provide inflationary pressure, but we're not seeing inflationary pressure. And why is that? And the problem with inflation is it's not quite something that people fully understand. Like even now today, we have models and such, but people don't fully understand what inflationary pressure is. Hello, Coco. Coco agrees. Yeah, see, Coco blesses this conversation. And when you've got this inflationary pressure not existing, where does that pressure go? Where is it hiding, right? Because money is being printed that should cause inflation, but it's not. And where it's going is what's happening with that pressure is it's currently building up. It's hidden at the bottom, right? And it's inflation, as we know, starts kicking in when velocity starts to come to play. And money has barely any velocity right now. People aren't spending. People are paying off debt because they're heavily indebted. So they're paying their rent. They're buying bare essentials. Money isn't moving very much. It's still moving the most in the U.S. compared to other places, but it's not moving very much in general. In Soviet Russia, you sit on Coco's shoulder. Yes. So this inflationary pressure just isn't manifesting. And what the Fed is doing, it's like Fed press button, monkey press button, economy, or not the economy, stock market booms. Monkey press button, stock market booms. Monkey press button, stock, but nothing bad happens, right? So it's a Skinner box game of like, press button, get reward, press button, get reward, press button, get reward. And there's no negative consequences whatsoever yet. And I think they lack the foresight to see that once velocity starts kicking in, once that money starts rolling through, when banks start to need to extend lines of credit to consumers, once consumers start consuming again, when the pandemic is over, that's where we're going to see a major boom in commodities as velocity kicks in and that inflation is unleashed. So and that's why I've advocated for so long to have a hedge in precious metals and or cryptocurrency, if that's your thing. I personally don't have a big cryptocurrency position at all. I think Bitcoin is due a pretty big reversal correction down maybe to 50% to a really, really strong support and build back up from there. I don't think it's going away. I just don't think it's going to stay up this high. So that's the story on real yields. That's the story on what the market's doing today. And today what we're seeing is we're seeing hope of recovery. We're seeing recovery hope. We're seeing stimulus hope. We're seeing hope that what the Fed said is true, that there's no real inflation, that we're just seeing healthy growth, and that's it. And I personally don't buy it. I don't buy that the stock market's current situation is based off of that real yields are rising on the back of real growth, and that the little bit of inflation that comes with that is just natural inflation that comes with growth. I don't think that's essentially true, and I think there's a very good precedent for not believing the Fed, because Fed has never, ever, 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 ever called the financial crisis. They've never, in their history of the Fed existing, they have not once called a financial crisis. They've always been reactionary. Not once have they said, "Whoa, well, things are looking a little scary right now. So we might be in for some rough waters." Never, not once. Everything was always hunky-dory until it wasn't. So I personally think, with barring fundamentals changing, we're going to see a continued slump next week and in the weeks after. I hesitate to call like a much heavier correction. I think 360 is about the bottom we're going to see for SPY, and I would dare say this isn't financial advice. Again, I say it every stream, but I'll happily repeat it. This isn't financial advice. It's for entertainment and informational purposes only. But I think for me, once SPY hits 360, that's an all-out buy signal, especially if it happens in 2 weeks, if it's a very slow roll down there. It's an all-out buy signal when SPY hits 360, and then we'll see again in a couple months. I don't think we're done slumping. I don't think we're, this is the end of the bear. Well, we had a 2-week bear market, guys. No. So I don't think the bear market's going anywhere. And yo, Dark, welcome to the subs. Let's go. That's awesome, Dark. All right, welcome to the subs. That's exciting. Let's go. So cool, dude. So welcome to the subs. And where were we? Shoot, you distracted me. Awesome. Thank you, Dark. I appreciate it so much. Look how many subs I got. That's crazy. Just compared to my viewers. Screams, but doesn't scream because I don't want to break your guys' ears. So yeah, two week slump. I don't think this was the bear market, guys. Back to 9 years of bull market we go. No, we're gonna see continuation of the bull market, and we're gonna see, I think personally, just a continued march towards inflation until it suddenly slams, and a lot of people are going to panic a lot harder than they're panicking now. I also think that what happened here, yo, Potato King, I'm ready. 27 minutes. That's all. I'll keep talking for 27 minutes. Don't worry. I got ready. Hi, Coco. So, later, Anto. Anto, it's been lovely having you. Thank you so much. There we go. So yeah, what was I saying? Yeah, a continuation of the bull market, and real yields are going to keep looking a little scary. It's going to look a little better in 2 weeks, I think. And from there, we're going to see inflation strike. And when we see inflation strike, I think the commodity super cycle is really going to kick in. And what you need to know, so I've talked about the commodity super cycle a few times, and I want to kind of illustrate this. So let me bring out my ugly as fuck, ugly as fudge. I'm sorry, Twitch overlords, don't ban me. Just a very ugly drawing here. So if you give me a moment to set that up. Am I going to use Paint or another drawing tool? I like the Microsoft whiteboard, so let's do that. Whiteboard. And I'm just going to doodle, so don't have too high expectations. It's going to look like Tam's first TA. So let's grab the... Not the one I want. Need to set up a bleep bot. Is there such a thing as a bleep bot? That would be crazy. Excuse me, Windows. Can I please capture my window? Be nice. Is there a window you will let me capture? New source. Draw board. Add source. And I want the whiteboard. Yeah. Okay. Need that to the bottom. Okay. So, grab my trusty. Oh no. Okay, everything's fine. Everything is fine. There we go. Got my drawing tablet. Not that it's going to look any better just because I have a drawing tablet. Oh god. That's because I have a drawing tablet, but we're going to try. Okay. So a bull market, when it starts, and oh no, it's already starting. High tech, yeah. I want to make a straight line. Windows, can you let me make it? Ryan, you don't allow straight lines unless I do. Oh, I know that. Don't worry. If you want to make straight lines in Windows, they won't let you just make a straight line. That would be too easy. How do I rotate you again? There we go. Making an actual straight line, no, that would be too easy. So we gotta do it this way. I want to make a straight line. There we go. This is fun. I'm having fun. Are you guys having fun? I'm doing all this just so I can have a little graph here. Yep. I know. No. There we go. Be gone, Toth. Okay. So when a bull market strikes or starts, a bull market doesn't just go up like this. A bull market doesn't go up like this either. A bull market always goes like this. Right? It starts slow, and as it comes along, it starts speeding up. And that makes sense, right? You can start with a $10 a day move, and a $20 a day move, and a $30 a day move. If I move my pen like this. So you can make smaller moves per day, but as the value of a stock or a commodity rises, as that value goes up, suddenly 1% isn't $10 anymore, right? Or 1% of the stock isn't $1 anymore. $1% becomes $1, 1% becomes $10, 1% becomes $100. So you're starting to see $100 a day instead of $10 a day, and you're starting to see $150 a day, $350 a day, and that's how bull runs work. They exponentially grow because percentually, if you have, let's say, gold at like gold at say $2,000, right? If you take 1% of that, we're looking at a 20% or a $20 rise, which is not that much. But if gold's at $25,000 or $15,000, let's say 15,000, right? Suddenly you're looking at 150 as a 1% rise. So that amount is paramount to this exponential growth you're seeing in a bull market. Now, I think this gold and this commodities bull market will last between 8 to 12 years. Okay, and I think it's already started. Let's say roughly 2 years ago, we're starting to see a bull run. So with this bull run starting 2 years ago, we're still in like roughly over here. If you look at the super cycle that I occasionally share on Discord, that means that we're early. It's cheap still, extremely cheap, and I think buying in now is like akin to buying in the bottom. And if you're buying at 1,600, at 17, at 19, at 2,000. It doesn't really matter because end of the day, I'm not in this for gold, 2,500 and call it a day. I'm in it for 2,500. 15,000. Yeah, I'm in this. I'm not in this for 20,000. I'm in this for 15,000 gold. And same goes for silver. I'm not in it for. I don't want $30 silver. I don't want $35 silver. I think once we hit $30 on silver, the road to 50 is going to be very small. And when we hit $50 silver, the road to 100 is going to be very small. The space there is very, very small. It's very thin. And that's a bit of TA, so Dark, you can probably understand this too. Once you're at an all-time high, the sky's the limit. We're filling gaps left, right, and center, and suddenly you're well beyond your all-time highs, and you're starting to fly. So that's my assessment on the bull market. And now that I have this drawing board, I'm just going to keep this in the background here so I can use it to explain whatever I need to with ugly-ass drawings. Yes, I will remind you need to finish my emotes. I appreciate it so much. The emotes are awesome. I'm just going to yeet one into the chat right here. Look at that. Look at that. Gorgeous. So that's my view on the commodity supercycle. Now, does that mean, okay, we need to go 100% into commodities? If commodities win, nothing else wins. No. I think that more expensive commodities means production prices go up. Production prices go up mean that products get more expensive. When products get more expensive, people can spend less. I'm hiring this guy if I ever get serious about Twitch again. Yeah, exactly. Dark's awesome. So I'm not in this for a small bull run, and as I was saying in this transition, I don't think equities stop playing a role. I still think equities have a place. When what matters is when this equity, what equity is going to be the winner in this. In 5 years, what's the world going to look like? That's what I think about, right? And I don't think about Peloton bicycle. Woo! Hallelujah, we got a Peloton bicycle. No, that doesn't matter much to me. What matters to me is what the world looks like in 5 years. I don't think a Peloton bicycle is going to make a difference. I don't think a Tesla is going to make the difference. Electric cars, however, could, right? So, and I think right now electric cars are in a bit of a bubble, so I think those are well overvalued, and I'm not too excited about any new electric projects coming onto the market. What I do care about is semiconductors, because those were already out of supply. They're ramping up production, and they're not going to be being able to keep up, right? The Internet of Things striking everywhere. You have chips in everything from billboards to your bicycle, to your Tesla, to your car, to your dashboards, your computers, your screens, your phones. Everything has microchips in it, and all these chips need to be produced somewhere. And they're expensive to produce. They're hard to produce. The production's hard to ramp up. It's a winner takes all kind of industry. So is there space for equity? Absolutely. I just think you need to be picky. In an environment where retail, and in an environment where the economy, and in an environment where consumers are taking a beating, the stocks that survive are stocks with strong balance sheets and strong cash flow. Pre-revenue stocks, pre-profit, pre-revenue, whatever the heck you want to name them, SPACs, they're going to be in a lot of trouble if real yields stay up. They're not going to, or if interest rates go up, or if yield curve controls start to come into play, those stocks are not going to survive in that environment. I don't think growth stocks have any place in that environment, and that's why I'm always for. It's fine if you want to play some growth stocks. If you have a few in your portfolio, knock yourself out. I think the key here is to be defensive enough to have enough positions that you can survive an environment, a market environment that is dustily negative for a longer period of time and come out of it unscathed or actually profitable. I think that's where you separate the men from the boys. Anyone can make money in the bull market, right? And if you made so much money, you're a millionaire and you got out, congratulations, blessings, you did it right. Odds are a lot of us haven't, and frankly, I personally believe slow and steady wins the race. So I think while it's totally possible to go from a very expensive stock to or from a very low portfolio to a very expensive portfolio with some risky moves, I think that's totally possible. But I'm not a fan of it personally, and I think the odds of it happening correctly are relatively small. And the success stories you hear are rather overblown, I think. So slow and steady wins for me, and on the side you just work, put more money into your portfolio every month, buy these defensive, well-positioned stocks that will simply make you money over time and multiply your money over many years. Most of us here are young, and that means that if you start now and if you make these correct decisions, then it doesn't matter if we're in a bull market or a bear market. You're going to be able to multiply your money significantly over the years. And if you have the time to devote to this, and if you're having fun doing it, of course you're going to have time to trade on the side and to pick fun positions and to trade GME when a craze happens, or to short squeeze, or to do whatever your heart desires. Gambling money is still gambling money, and I still go to a casino. There's nothing against going to a casino or trading stocks. So when I disparage trading on the Discord, what I'm actually saying is the problem is that when people talk about, gambling, or talk about investing or trading like it's a gamble, with gambling positions that have no bearing in the real world, that's when I get aggro on that, because I want to make absolutely clear that definitely, it has a place. You can do that fine. If you have the funds to gamble away. Who cares? Might even make a buck, right? The thing is, when people see that, people that are new to the market, people that are desperate, people that need money, people that are seeing all these other people claiming how much money they're getting, when they see that, they don't think to themselves, this is somebody, playing with his gambling money on the side, and he's probably got a nice defensive portfolio. They think to themselves, dang, I'm an idiot. I should have done that too. I should have bought, 100 million Nikola stock when I had the opportunity. I should have started scalping options because I saw this thread on Reddit where somebody made $16 million and he only started with 1,000. And because there's no context delivered with these posts, it's just naked celebrations with no context of something that may or may not have happened. It's potentially photoshopped or even easier, dev consoled images of portfolios that are most likely complete bogus, right? But that's not how the human mind works. You see this and you go, damn, I'm so jealous. I want that too. And I think that what the internet lacks right now, especially among people our age, between 25 and 40 is a voice of reason. Like if a 40-year-old tells you, "Oh, don't do that," you think, "Oh, you're just old. You just don't understand the new ways," which is exactly what these kind of people that want to sell you something are saying, right? All these boomers don't understand. There's these new ways of investing. They're just behind in the times. But what they don't, what I think the world needs, or what the financial world needs in our age group, is moderate voices that look at that and say, okay, I can totally see how that might work, and I can explain to you how that might work, and we can do the math together and probably find out that it's bogus. But what you need to understand is there is a way to use the stock market at our age to a tremendous effect. The amount of money you're leveraging if you're in the stock market for 60 years is insane. A lot of these boomers, they haven't been in the stock market till their 40s, their 60s. They were already rich when they started. Right? The compounding effect, compounding interest, is such an underrated effect on your entire net worth. And because you're starting so early, you don't need to pick these winners. There's always been gurus since day one of the stock market. Absolutely. And there's always people trying to sell you something. But I think the big difference is because of the speed at which communication happens these days, and because of the nature of this bragging that happens and this talking about things like they're the new normal and there's nothing else exists, I think that is causing a lot of people that are new to this they don't have the perspective to see, wait a minute, it isn't normal to make 50% a year, let alone 100 or 200, 300, 400, 800, 7,000%. That isn't normal. We're living in absolutely exceptional times, and it's perfectly fine to enjoy that. It's perfectly time to dance with the bulls. But it's also fine if you're seeing all these warning signals to think, okay, but what if it's no longer fine? Where am I then? What happens if my numbers are so high right now? When do I take profit? It's okay to ask that question. And there's nothing wrong with taking profit, and don't let anyone tell you otherwise. Like, oh, paper hands. Oh, it's 2 weeks later and I'm 2% higher than where you sold, you idiot. No. He's the idiot if he stayed in for much larger risk than you. You made the right move, even if he ended up higher. That doesn't mean that your move was wrong. In fact, it might have still been the correct move, despite the stock having gone higher. And that's why I often talk about risk-adjusted returns and yeah. So see, Dark, when you say that, that's fantastic, and I love to hear that you manage those numbers. But what you often don't add is, it was on a portfolio of $100, and you've YOLO'd that portfolio several times over that time frame, right? So making 2,000% on a small portfolio with very little risk is very different than, if the and just for people that can't see the chat right now, which is everyone, Dark agreed. Yeah, he couldn't. So, or he did with $100. So 2,000% returns is fantastic, and I congratulate him, and that's fantastic. Good job. But if you do that with a portfolio of $25,000 and that's your entire life savings, you're insane. Because if you lose that kind of money, that's not something you just easily recover from, right? And we're still young; you can definitely recover from it, but it's not something you easily recover from. It's not something you're going to forgive yourself for very easily if you gambled away that money. And gambling is a real addiction, and gambling addictions are absolutely triggered by the stock market. And gambling effects that happen on your psyche when you're trading are absolutely the same that you get in the casino. Doubling down, wanting to make back your losses, bag holding. All of these things are things that exist in gambling, right? And all of these effects are effects we see in gambling. So this is something that's very real and something to be very aware of when you trade. And that's why I try to juxtapose, these people that are making these outrageous claims with, okay, but now let's take a step back and go back to reality and talk about how to actually leverage the stock market to your advantage in a consistent strategy that should work for everyone, rather than this inconsistent strategy based on TA or your personal talent, which I'm sure exists, but that's not replicatable. That's not something everyone can do. The average person that isn't as good as math, isn't as good as intuiting TA, that isn't as good at telling human nature, that doesn't have the time to follow the signals. Even when when I talk about semiconductors, I constantly say to people, if you don't know how semiconductors work, if you don't know that industry, you don't understand what's playing there, if you don't know the players, don't invest in it. It's not for you. And I'm not saying that because I want you to miss out on any gains. I'm not saying that because I don't want the semiconductor business to be popular. I do. If it's popular, I just make more money. But that's not relevant to me. First of all, I don't think SMLC can push a stock like that, especially not large caps like these. I think that the important thing is that you trade what you know. That's a very Peter Lynch thing to say. But trading what you know is what gets you the most gains. If you work, and this is again straight from Peter Lynch's book, if you work at a pharmacy, right, and you see pallet after pallet of a certain medicine leaving because some disease is going around, or people are getting ulcers, or getting something in their mouths that's annoying, that they constantly need the same medicine for. When they stop using the medicine, it comes back. That's when you look at the back of the package and you go, wait a minute, who makes this? I see pallet after pallet. It's our best-selling product right now, and it's selling like hotcakes. And there's an underlying medical condition that a lot of people have that isn't going anywhere, right? If you're that pharmacist, right, and this happened. Like if you look in the 90s, this is a true story. This pharmacist had this exact situation happen, and with this medicine that he's selling over the counter in hand, he's got it right here. He's selling it to this guy, and meanwhile he's thinking, I wonder how my oil stocks are doing. Can you imagine? He's got a gold mine in his hands, and that stock, that medicine stock, went up 60 times, right? And when he spoke to Peter Lynch about that, he was talking to him about the fund, and he ended up talking like, okay, I'm a pharmacist, I do this, I do that. What do you think about oil, Peter? And Peter said to him, why do you care about oil? You're a pharmacist. Do you understand oil? Do you know where it comes from? Do you know the players? Do you know where it's consumed? Do you know any of the signals that would signal up or down in oil? Do you know what macroeconomic effects oil has? Do you know what will knock it down as the king? Absolutely not. So even if you make money for 10 years on oil, if that's what you've been doing for 10 years to make your money, odds are in 11 years you're still going to be in oil. Okay? And if that 11th year is the year that kills oil, there is absolutely nothing you can do to protect your wealth because you do not understand it. And that is the crux of what Peter Lynch is trying to teach in his book. And what he's trying to say when he says trade what you know. Understand the industries, and that goes for both TA and FA. Trade what you understand. There are, in every single industry, there are good picks. Today, yesterday, a month ago, a year ago. I'm talking about Peter Lynch's book. The title escapes me, but I'll put it in the chat after the stream. I'll look it up real quick. But in one of Peter Lynch's book, I believe it's called Trading What You Know, but I don't remember exactly the title of the book. But he explains, he talks about bottom fishing. He talks about trading what you know. He has a few great anecdotes in there and a few great talks as well. So I'll definitely give you the title after the stream. I might look it up right now. Actually, 1 second. Yeah, it's one up on Wall Street. Yeah, exactly. Yep. Yeah, and exactly, it's all about leveraging your knowledge and leveraging what you know and understanding that there's winners in every industry. If you sell donuts, trust me, there is donut related stocks out there that you can trade and make money off. If you sell insurance, trust me, there's plenty of insurance money and insurance companies that are there to make money off. Even if macroeconomically insurance aren't doing great, you sell a specific type of insurance. You know when that insurance start becoming more or less popular. There's so many effects that each and every industry has on other industries and related industries that you will guaranteed find something that you're passionate about or that you're knowledgeable about, that you have one up on Wall Street on. Because Wall Street are a bunch of analysts sitting at an office in Wall Street. They're with financial educations. Okay? They're not insurance officers who understand, the nitty-gritty of selling insurance. They're not, cleanup people that work on sewage and other junk. They don't sell donuts and they don't work in pharmacies. Yeah, those analysts that are working on those analysis, they do great FA. Fantastic. But that doesn't mean they know the market as well as you. And when you know the market and you do your analysis, that is when you pick winners. I see a weird blue light above me. What's going on? Oh, it's on my screen. It's not actually behind me. I'm actually I was like, what is that blue light? Why is there a blue light above me? Exactly. The sewage cleanup comment. So trading what you know is essential, and I think you can pick a winner within every industry doing so. And that's why I trade commodities. I understand commodities. I understand the commodity super cycle. I understand what role commodities play in the world. And my history, my education is in history and geopolitics. Okay, and commodities. If there's any education that has a big bearing on commodities, it's probably geography and history and politics. Because if there's one thing that's real, it's commodities. That's the one real thing that countries have. Resources. Yeah? Trading fiat currency. Fiat it's also real. But it's definitely being traded right now, but it's not as real as commodity. Trust me, if you have $100 worth of commodities here and $100 worth of cash here, I guarantee you any country is going to take the $100 worth of commodities. It's simply worth more. It's that simple. So that's why commodities are for me. I've been a gamer all my life, so gaming stocks, easy second industry to try to make myself an expert in. And finally, we have semiconductors, which is an industry that I personally find interesting. I'm big on IT. I understand how chips work. I've always understood how most hardware works. So it's easy for me to follow, and I think it's one of the biggest industries in the coming 5 years. So that helps. I'm in cybersecurity and a couple other things, but largely those are what I consider myself an expert on. And without too much hubris, what I'm trying to say is I think everyone is an expert on something, and allow yourself to leverage that. And don't just I call Dark out on this all the time, where he's doing TA on some like, what does this stock even do? It's like, I don't know, it's going up. And I think that's wrong. I think if you're doing TA, even if it's for a super short-term trade, you can do TA on a company you understand. Dark loves it yeah, exactly. You love it when I talk smack and we're like, hey, think about what you're doing. And I think that's true for everyone. And also people do it to me all the time as well, and I appreciate it. It's good to get a reality check once in a while. I was thinking about shorting CCIV. I ran it by one of my mentors. And he was like, well, sure, you're right. It's definitely got a lot of hype and it's definitely bubbly. But on the other hand, they have some skilled engineers there, they have some history there, and there's Arab money behind it. There's definitely merits to the case as well. I was like, well, good point. Actually, you know what? I'm not going to touch it. Reality checks are great, and it saves you pain sometimes. I think I would have made money on that short, but that's irrelevant. What's important is that your investment thesis is correct, or your TA thesis is correct. And to make it correct, or to help make it correct, doing it in an industry you understand is absolutely essential. So I want to be live for about 15 more minutes, and I want to dedicate that time to seeing how looking at some tickers you guys have been looking at. So in the chat, let me know if there's any tickers you guys have been looking at, preferably no biotech, preferably no meme stocks, but even meme stocks if there's something really big. Feel free to hit me with it. I have one that I wanted to dive into, definitely a meme stock, so keep that in mind. And yeah, Potato King, I know you've been a loyal watcher this entire time, so I'd love to hear what you're invested in, what you want to know about. It's actually benefited me. That's dark talking. It's actually benefited me. I built an FA questionnaire that I have filled out before I take trades that have been really helpful in learning more about tech stocks or about the stocks that interest me. PSLV. I think I've talked enough about silver. I don't want this to be a silver themed stream. There's plenty of super bullish silver streams out there that will promise you the world. I mean, I can give you the long and short of PSLV. They're adding a ton of volume every month. People are still buying it like crazy. Silver premiums are going up. I'm unconcerned about silver. My silver thesis is still correct, and because it's still correct and it's seen such a massive dip, I'm buying more, and that's worked out for me. AFIN. Let's take a look. American Finance Trust Inc. $9.72 stock. So under $10, in my opinion, is a penny stock. But that's okay. It's almost not a penny stock, so I'll give you credit. Let's take a look at the profile. GME to the moon. Get out. Let's see here. I called the top on GME. So I'm still pretty proud of that. I actually clipped it. So take that, nerds. Let's see. Actually, in fact, I called it so hard. I actually traded it like from the 95% to the 100% and then sold. Bigly can confirm. Let's see. American Finance Trust is a publicly traded real estate investment trust listed in the NASDAQ, focused on acquisition and managing a diversified portfolio of primarily service-oriented and traditional retail distributed related commercial real estate properties in the U.S. Okay, so they're based on New York, and essentially what this is commercial real estate. So cinemas, malls, shops, restaurants, the works. Gosh, man, I'm extremely new to the market. I can't really say that I'm looking at anything specific. I'm a PSLV and AG just because I've been following silver. I generally believe in it. Also pretty sure I've got the sub. Hey, there we go. Hey, let's go. Yeah, I think Potato King's already subscribed. So, hell yeah, brother. Let's see, where was I? Oh, yes. So we got the commercial real estate, and there's two kind of cases on commercial real estate, right? All the money onto the stream. What I'm gonna do with, first of all, I don't think I'm gonna see any actual money anytime soon because Twitch only pays out 50%, and you can only withdraw money when you've made, I believe, $100. So with 3 subscribers, which I think I'm on 3 now, that's $15 every month. That means I need to stream for let's see, about 9 and change months to get to my $100 to actually get it. But when I do get it, it depends if I get more viewers or if we'll get there. Yeah, I mean I intend to stream on Friday for the coming year. So we'll see what happens, and if that blows up, it blows up. Awesome. I look forward to it. If it doesn't, it doesn't. And I have fun doing it regardless. I think you guys are amazing. So what I'm gonna do with those profits, if I do get them loose, is pay Dark first of all for the art he's made. Still waiting for Joker ETF. I'm also going to reinvest it into getting analyst reports, and I will then use those analyst reports. I will either convert them or I'll see what I can do legally to put them on screen here and to just go through them together with you guys. I think that'd be super fun. You know, buy analyst reports for some stocks that I personally believe in and see what those analysts think. Cross-reference it with what I think, and kind of show you guys how professional DCF is done. I think that would be exciting. And I already have access to some of these reports, but those are given to me personally, so I can't share those. But if I buy them from like a cheap source like Morningstar, I think I can definitely look into sharing those. So I think that would be fantastic. Anal list reports would be great. Exactly. I would imagine the sewage cleaning guy loves anal list reports. So that's the plan with the profits of the stream, and I bless all of you for subscribing. I think mostly what it just does is make me excited. It just warms my heart to say I'm like, oh, I'm all giddy. So yeah, definitely Friday streams consistently, and then throughout the week I'm gonna look into doing gaming streams. Thank you for the thumbs up. Love the vote of confidence. Hi, Tabertastic. Welcome to the stream. Love the follow. Welcome. Oh shit. Is there something to oh shit about? What's going on? I was like, what game am I playing? Oh no, it's from my stream. All right, so back to acquisition, American Finance Trust. So the thing with commercial real estate is can go two ways. One, the pandemic is over, right? If we consider the pandemic to be over, and in June, July, summer hits, people are going out again, the economy is opening up, nobody's, masks are kind of on and off, people are starting to trust and feel safe again to go out. And I definitely think there's a lot of pent up need to go out. You're still streaming a drawing, not sure if that's intentional. Yeah, it is intentional, just to have something in the background. I guess I can stream just what I'm looking at on my browser. Just stream my browser, that'd be fine too. Let's see if I can stream my browser instead. I don't want to stream that. Can I not stream? I don't want to stream that. Can I not? Slobs is definitely bad at like running, showing me my latest. Okay, remove that. Add new. Window capture. New. Edge. New source. Yeah. Streamlabs. That once. Boop. Hello, I'm back. I'm alive. Okay. So what I think about AFIN is that the economy could open back up, and a lot of people are pent up. They want to go out. They have some money saved up to go out for dinner, to go on vacation, to go to the cinema, to buy things, to consume. Fantastic. I think that's definitely going to happen. The problem is I don't know when the pandemic is going to end. That could very well take up to 2022 before the economy properly opens up. If we're going to see a prompt third wave, then I definitely think Biden would be, the president to shut down the US or to partially shut it down. And there's also virus fears just from people that are just normal thinking people that, despite the economy opening up, will be trepidatious about going out and consuming and buying and being in public spaces, going to clubs. So all these commercial places have something to look forward to. There's two questions. When can they look forward to it? And I don't know, which is part of the reason why I wouldn't invest in this, because if in 6 months it turns out, no, we're shutting back down again, it's going to take another year, that's nasty. And it's going to be nasty for commercial real estate. Secondly, a lot of these commercial real estates aren't stupid. And what they've done is they have delayed the debt of their commercial partners or lowered the prices of their commercial partners for the duration of the pandemic. So a lot of restaurants, a lot of commercial shops, a lot of cinemas, they're paying small or they're paying smaller rent, or they're not paying rent at all, right? They're renting for free. That doesn't mean the acquisition or the commercial real estate company has no costs. Costs are still very much there. The bills need to be maintained, contracts need to be renewed, and oftentimes they aren't forgiving the debt. They're simply saying you don't have to pay right now. But when your business opens back up, that's when we're going to start collecting. We're just going to take, you're going to pay 120% rent for 5 extra months, and that's the way we're going to cover, the extra month that you got for free. Or in this case, they got much longer for free in some cases. So a lot of these commercial places have a lot of outstanding debt towards the commercial real estate company. The problem in this is that the commercial real estate company is counting that debt as income that's deferred or that's still coming in. It's on their earnings report. It's on their balance sheet as debtors. There's a debt outstanding. That's money that they're due to receive. But on the sheet, it doesn't tell you how likely it is for them to receive that money. But with equity, what we'll be looking at is inventory. If inventory moves but debt increases, that means that they are failing to collect on their debt. And if that is a consistent behavior, that means that this company has got debt that they're going to be forced to forgive because there's just too much outstanding debt from before. So somebody owing the company money, right, that isn't being worked away, that they're not managing to collect. If you can't collect, you can either sue, and which costs a lot of money per individual, or you can give up. It's not commercial for products to sue in most cases, so they're gonna have to forgive that debt. You know, you're selling flowers to a flower shop. If that flower shop is broke, you can sue them all you want. You can't pluck a naked chicken. So that's a Dutch saying, by the way. I hate you with a Dutchism. You can't pluck a naked chicken. So the same goes for these commercial real estate companies. If these companies are broke, and many of them are in debt right now, and they're not in debt for 1 month of no production. They're not in debt of 3 months. No, they're in debt for 6, 7, 8 months, right? So 6, 7, 8 months of debt built up for a lot of their customers that they on their balance sheet are saying, nah, that's money we got. That's money we made, right? That's just debtors. We're going to collect on that debt later. But what happens if 50% of these companies, when things open back up again, and all these companies are going to say, oh, well, hang on a minute, you're open again, pay up. When all these companies do that at the same time, what do you think is going to happen to, Joe's Cheese Shop? Joe's Cheese Shop is going to go broke. It's not going to be able to pay all those debtors. He's going to get sued. And only 1 or 2 of those debtors will get away with the money. And the rest will be left empty-handed. So that means that debt has to be forgiven, and that means that their profits will suddenly dump, and they have to make a correction in their books. And that's the bear case for commercial real estate. That's why I want to be cautionary and say, yes, commercial real estate definitely has more of a bull case than private real estate, I think, houses. I don't think commercial real estate is nearly as much in a bubble as private real estate is either. Either, sorry. My Dutchism creeping in sometimes. I'll get to your question in just a second, Dark. So your risk is the potential reward is things open back up again, things go honky dory, companies start to pay off their debt, real estate company makes money. Bear case is real estate company cannot collect on their debt and therefore will lose money on what happened the past few months. And this is the best it's going to get, right? Because right now all those profits are still on the books. All those companies aren't officially bankrupt yet. They will start bankrupting as soon as the economy opens back up and everyone's like, okay, COVID's over, sympathy time's over, pay up. So your question is, doesn't that offset with acquisitions? I'm not quite sure what you mean by that question. Do you mean that all these small companies are going to get acquired and therefore their debt's going to be paid by whoever acquires them? And I'll get to your question too, Kyron. How do you make money in a bear market? What an exceptionally broad question that I will happily try to answer. So got these strips here that are green on my chair. So I've got this weird halo of, I can make the text like fly through my chair. Doesn't that mean they acquired a property and a company? No. Because these companies have debt outstanding to more parties. So they cannot acquire the company. At most, they can acquire the real estate because that's theirs, right? They're renting it out in most cases to these companies. So the real estate remains theirs. But that's always been theirs. So there's no money made there. It's not like they will take the real estate from them. Oftentimes, they've been renting it out. In fact, I was reading their corporate set up, and they are renting it out for the most part. So there's no acquisition of property. Acquisition of companies is it's not possible because, first of all, they're going bankrupt. They don't have to yield their company to them. But second of all, the crux here is that inventory that does remain, that needs to be sold off to cover debt, is going to be claimed by everyone involved, not just the real estate company. Right? And then it's up to the lawyers to try to get the biggest piece of the pie. I don't know if they will. And it's expensive to do. So for inventory of a flower shop, inventory of a cheese shop, inventory of, if it's an inventory of a big retail store, sure. But I don't think those are the ones going bankrupt. I think it's smaller boutiques and such that might go bankrupt, and the inventory there is negligible at best. So I think there's a real risk there, and I cannot judge how big that risk is. So maybe there are some commercial real estate companies that are not exposed to this risk nearly as much, or they have a guidance on their financial statements that say, okay, we expect 20% write-off, 10%, 15%, and that's priced in. Could be, and if it is, then that might be interesting. If you do believe in the recovery, and if you do believe everything's going to be hunky-dory, then I would keep that position small. And that's what I personally would do if I would choose to take a position in real estate. I just am not currently of the mind to take a position in real estate for exactly this risk. I don't know how long the pandemic's going to last. Risk number one. Risk number two is when it does end and debt is starting to be called in, those companies will go bankrupt after all, and there's going to be a lot of people losing out on, or a lot of real estate companies losing out on a lot of money that they have put on their books. And it's going to have to be corrected after the fact, which is going to hurt the stock price. So, question by Kyron: how do I make money in a bear market? Why are commodities getting killed during this market correction? Well, those are two very separate questions. Let me start with the first. During a market correction, there's a lot of positions that are going to get margin called. Okay? So a lot of open positions that hedge funds have, that institutional money has, but also that retail has, outstanding, that they will want to keep, that they're going to get margin called on. And the first asset that always gets liquidated, because it is literally money, to cover those long positions and to cover that margin, is usually precious metals. So during a sell-off, during an early stage of a correction, gold and silver always front run it. They always get hit hard because those are the positions that will get closed out to cover margins. Okay? Now, once the dust settles, before equities start rallying again, often gold and silver are also the first to rally. But in the case of an extended correction, a second effect kicks in. So those margins get covered, sure enough, and commodities take a hit. But what happens after is, if the extended corrections take place and fear starts to expand and people say, wait, hang on a minute, this is starting to look like a bear market, this is more than a correction, at that point, money starts fleeing somewhere. Money needs to get out of equity, money tries to get out of bonds, and it needs to go somewhere else. The typical option is commodities. And therefore, what you see in an extended correction or at a bear market is money then starts fleeing into gold. And I think you saw it during this correction too. At first it took a hit, but after that, gold stocks especially remained super steady during this correction. The gold stocks have barely moved. It has remained rock solid, and I think that's an extremely bullish signal on gold. So that's why commodities got killed during this correction, especially silver. Silver is far more volatile than gold. So when this hit comes, silver gets liquidated. Shorts gain more power. Stop losses get triggered, and you see this price cascading down as margins get covered. And then now the margins are covered, you're going to see a recovery, unless the market continues to go down or there's other bearish signals on precious metals. So that's the precious metal story on the short term. How do you make money in a bear market? The answer to that question is quite simple, and it's value stocks. Typically, during a bull market, growth stocks outperform value stocks. The reason that is because you've got all these companies promising future profit that are able to run on lines of credit that banks can extend during a bull market. Because during a bull market, there's a lot of liquidity, a lot of money going around. There's a lot of money going around. Banks have an easier time extending lines of credit to companies that don't make money yet, so that need to build up debt to build up the company. So that's what we call a growth company. Think about Tesla, a company that seeks to grow much faster than they seek to make a profit. Value companies, on the other hand, are companies that have a very strong cash flow and balance sheet. Companies that are already making money, that are seeking ways to make more money, that seek to increase their product margin. So for every product sold, they seek to make more money. They're companies that have strong cash flow, that have a proven product line, have a large moat, so that is hard in a business that's hard to penetrate for other businesses. Say I make rubber ducks. This is a random example. If it's easy to make rubber ducks and I make a lot of money, other companies are going to also make rubber ducks, and that's going to cut into my profits. But if I make semiconductors and it costs over $1 billion to set up my first semiconductor machine, not a lot of other people are going to be like, Daniel makes a lot of money with his semiconductors. You know what? I'm going to also start making semiconductors. It's not that easy. With semiconductors, you need a lot of expertise and you need a lot of money to set up your machines. Those machines are very expensive. And the expertise is also very expensive. There's only so many people that know how to do it. So that's what we call a moat. So companies with a large moat that are making a ton of money, that have a crazy amount of cash flow, right? And have a strong balance sheet, so they will survive a correction. They don't care about that correction. They have cash in the bank. They can take the hit. Those companies are going to see value, and they're going to see a rise in their stock price during an extended correction or during a bear market. Because when money starts fleeing, it's going to look for equity that does exactly that makes money. Because if it makes money, it's not going to go bankrupt. When it's not going to go bankrupt, it's going to outperform all those other stocks that are, right? And it's going to outperform the market. So during a bear market, the place you want to be is commodities. You want to be where money flees. Where does money go? It's the question you want to ask yourself. Where does money go in a bear market? The answer is value stocks. The answer is commodities. The answer is the answer might be Bitcoin. I don't think having a small position in Bitcoin is wrong. Quite the opposite. I think having a small position in Bitcoin is correct. Silver's definitely got hit pretty hard. I'm down for the first time in a while in my long position. Yeah, I'm also still in silver, and it definitely went down. I'm down over 50% of my profits. So I should emphasize here, not my portfolio. My profits since the start of the year is down about 50%. So that sucks. But it is what it is, and we'll get out of it just fine. I'm not concerned yet. So there's that. Dark mentioning, I've got other positional interests in insurance companies. I don't like insurance companies. I don't understand them very well. My stepdad is in insurance. Insurance works a lot with lines of credit, so insurance does well when banks do well. Banks, I don't think, are doing very well right now. Banks are in a lot of debt. They're just in a nasty position, and banks have a couple ways of making money, and one of them is completely dead. Lines of credit that banks extend are supposed to make them bank money. That's how it's supposed to work. But lines of credit aren't making the bank any money, because interest rates are so extremely low. The only thing that makes the bank money is printed money, first of all, that they then put into equity or bonds. And that is just very limited. So I think banks are not a great place to be for a long time. Health insurance, I don't know. I'm no expert, especially not on the US market. So if you find, like I said, you can find winners in every industry. So if you know health insurance very well, if you know insurance very well, by all means, find the winners there. Find the ones that fit your investment profile and that fits the offensive or defensive position that you wanted to take in your portfolio. And I think that's a nice wrap up as well. And I think it's going to be a nice transition into next week. I want to discuss portfolio balance next week. I'm going to open up an Excel sheet next week and show you guys how I balance out my portfolio and how I think other long-term investors can definitely consider doing so as well. I also want to leave the stream with a simple piece of advice. And that is that if you don't have a lot of time, you're a student, you're working full-time, you're juggling a lot of things. If you're simply not sure where to put your money, if if you don't have the time to investigate picks, to take your time and listen, please consider simply going into an index fund, an ETF. Pick 3 ETFs if you want. Odds are the market's still going up, and the only time those will underperform is when the market's not doing great. But historically, ETFs and index funds have performed far, far better, not just than retail, but than professional investors too. And I think that little truth is what we really need to get through your noggin. Index funds tend to outperform institutional traders. And with that little bit of wisdom, I want to leave you guys. What ETFs or index funds would I recommend? I'll talk about it a little bit in chat in the SMLC Discord. I want to invite everyone that isn't on the Discord. Take a look at my description in the doobly-doo. And, in there you can find links to the SMLC Discord, to some personal stuff, to my PayPal if you want to donate. If you make a donation, I will make sure to put that on the profile into SMLC as well, and I will put that money towards getting analyst reports and discussing them with you guys. You're very welcome, Tiber. Welcome to the stream. It was lovely having you, and thanks for the follow as well. It's great interaction. I'm having a ton of fun. So I'll be here every Friday. You can see my schedule in the doobly-doo as well. So thank you guys so much. I'll be there next week. We'll discuss portfolio balance, and we'll discuss some specific ETFs and tickers, index funds that I personally think are a safe place to be. So thank you guys.